Hi, this is David with the Enzo Trading System. This is going to be a review of all the new algorithms as they are applied to years 2020 and 2021. These are going to be back tests, so they're never 100% like the truth. The old algorithms, they've been updated somewhat, so they're not quite like what we had in the previous year, even in 2021. But they're a fairly good representation of what we would like to show, which is the some points of difference between the older and newer approach. First of all, also I should mention that our focus really has been on Bitcoin since the end of 2021, mid to end of 2021. So the test that I will show here, they are on Bitcoin just because it's simpler to make a case. But the performance really, our performance metric nowadays is really on a portfolio of multiple crypto markets. We currently openly trade 19 markets. So in terms of profit and profit risk ratio, trading multiple markets is definitely the way to go, and we no longer really trade on any specific market. We're just focused on multiple markets. But Bitcoin, of course, is the one that has the most correlation with many other cryptos, especially in certain periods of the markets, especially in negative periods of the markets. So we'll use Bitcoin as an example. And so going forward with the back tests here, I already ran them. It only took a couple of minutes anyway. Here we have, first would like to focus on the year 2021. We've all been through 2021. These are the older algorithms, and as we can see, the performance was pretty poor. Again, these have been updated towards as the year has developed. I made some changes to make sure to get these algorithms as kind of closer to what we had at the beginning of the year rather than towards the end of the year. So it gives a better perspective on things, but they're not quite what they were. But that aside, the performance was really poor. Especially on, in particular on Bitcoin in this case. We can see a performance only 14.5% and maximum drawdown 40%, which is pretty large. This is a stark contrast to 2020, where officially we had 120%, but because they are kind of improved algorithms compared to 2020, even though they are older than what we have right now, and they're actually algorithms that we don't use anymore. In 2020 was actually quite a bit better in general. Officially, effectively, we had under 20%. With this slightly newer algorithms, it would have been closer to 200%. 2020 was a much easier year to trade, and the drawdown was only 15% in this case, whereas in practice we got 25%. So now let's take in contrast with the 2021 with the new algorithms. We would have had 103% with only 10% maximum drawdown. This is a great improvement compared to the older algorithms. And one thing to notice is only 158 trades with the new algorithms instead of 732 trades, so much less trades. And 2020 is actually kind of a different case, because with the new algorithms and in 2020 the performance would have been worse. Again, this is the latest algorithm and the oldish algorithms. And so instead of almost 200%, 88% profit, maximum drawdown instead of 15%, 20% maximum drawdown. So larger is worse, and the return over maximum drawdown is 4.4 instead of 13. So a couple of things to notice right away. There is also, we use, of course, profit and as a metric for quality of an algorithm. Of course, we use profit, we use a maximum drawdown, and the relationship that would be profit divided maximum drawdown. But there are other two things to consider. One is a Sharpe ratio. Sharpe ratio is better with the new algorithm, whether it's in 2021 or 2020. So 2020, a new algorithm's Sharpe ratio is 4.0. 2020 with the older algorithms is 2.0. In general, Sharpe ratio 2 and higher is pretty good. Of course, 4 is much better than 2. And here for 2021, it would be 7.4 instead of 0.9, which is indeed poor and it actually reflects other parameters. Another thing that should be noticed, I think we can make a case, definitely we can make a case on 2021, probably also in 2020. Yes, maximum drawdown is really important. It tells what was the maximum drop in value of a certain fund that was being traded. But there is also the concept of for which we actually don't give statistics right now, but we can eyeball it. The average value of the maximum drawdown. So we can see even in 2020, where the new algorithms were gave less profit, we still had maximum drawdowns that were kind of, for example, in January was only 1.73, and in January for the older algorithms, those that performed better, it was already 7, and again in February was 1.5, and for the older algorithms would have been 8.4. So of course, I mean, one usually worries about the maximum drawdown because that's the maximum loss, but also there should be considered how much the fund fluctuates, and higher maximum drawdown split month by month means also higher fluctuations. And that also correlates to the fact, and it explains why we have a Sharpe ratio that is higher in the case of the new algorithm, whether it's performed better or worse in terms of actual profit. It's because a Sharpe ratio, it's a valuation of how much not only certain trading strategy performs, but also how volatile is the return given. So I think now I would like to do another consideration. One is a little bit more subtle, and this one that about trading commission and slippage. So again, let's take the worst case scenario, the 2020, meaning worst case as far as the new algorithms compared to the old one. For 2020, the new algorithms would have performed worse. Still in profit, but worse. So now, let's say that we're trading a fairly larger size. So in general, when we do backtest, we kind of put in some slippage in the mix, but slippage really it's a factor of our trading size. So let's say that slippage is negligible when trading $100,000. But it becomes a bit of an issue when trading $1 million. So we can, the easier way to simulate a worse slippage is that of increasing the commission, the trade commission. In this test, I'm using a trade commission of 0.075, which is that of, as far as spot market, that's what is applied to both Binance and Bybit. And as far as futures, actually on Binance it would be less, but on Bybit it would be still the same. And so actually I'm not sure about Bybit spot market commission, whether it's different from futures, but here we're just assuming that we have the same commission, which is not small, not high. And let's simulate now that we have 2 times the trade commission. So it's going to be 0.15% per trade. So I will change for the new algorithms and now for the old one. And now we actually, things are evening out, because we went from 88% profit with the new algorithms to 66% profit, but with the older algorithms we went from almost 200% to 88% profit. And the maximum drawdown now it's the same, 25% and 25%, and the average maximum drawdown is it's better in the case of still better in the case of the newer algorithms. And Sharpe ratio, it went from 4 to was it 4 here? It was from 4 to 3, and from 4 to 2.9, and here went from 2 to 0.8. So once we increase the amount of commission to simulate higher slippage, which one should expect higher slippage as trade size is higher and higher. And so the premise was, what if instead of 100K we're trading $1 million? Then this becomes more realistic, and suddenly the newer algorithm, even for the year 2020, would have been better than with the older algorithms. And the reason for this, it's really that just the number of trades. The more trades you have, the more commissions you pay, and the more chance for slippage you have. And so in the case of 2020, we went from 198 trades to with the new algorithms to 636 trades with the older algorithms. So generally, having more trades, it can make for a smoother profit curve, but at the same time it can be quite dangerous, because it can bring a lot of unforeseen commission costs or slippage costs. We can calculate what the commission is at a given commission price, but slippage, we kind of have to fudge it in, perhaps put it into the commission value here. One could have a simulation that is more accurate, more in tune with what the actual slippage would be, but we didn't do that. We just, it's kind of a complex problem actually. And so we can see that even for 2020, I would consider the new algorithm to be more reliable. So if we switch back again to 2021, here is a lot easier. Yes, 2021 was pretty much a disaster with the older algorithms, and in fact things have gotten considering, I mean, this is without leverage. Actually, with leverage it would have been worse. We managed to do better than this simply because we eventually we switched to the new algorithms. We made a series of changes, and also we of course we weren't only on Bitcoin. We introduced first 4 additional markets, and now 18 additional markets. And that's really where I want to make this clear again. Our focus really is on multiple markets. I think that's really where the future is. You know, all due respect to Bitcoin, I think diversification is essential. And again, now let's let's have a laugh with 2021. Let's say that we were trading a big size with the new algorithm, so we're factoring in, we're doubling the commission, we're putting in 1.5, and here in the case of the older algorithms, we put 1.5, and suddenly instead of a plus 14%, we're a minus 27%. And here we went from what was that, 88? I keep forgetting. It was 102.8, and instead it only went down to 85%. And the maximum okay. Oh, and the maximum drawdown now it's like only 10% here, and here is 56% close to. And again, the big issue really is the number of trades. A larger number of trades can easily bring to unforeseen, I mean, it can easily degrade the final result compared to a back test. You know, maybe I'm being excessive by doubling the commission that is visible, but I think it's better to be safe. And that's basically, I think, really the main reason why the new algorithms, I think they can be relied upon. I mean, there are many reasons, but the one that it makes it automatically more scalable. And so so now I would like to put all together and really show 2020 and 2021. No, not myself. And 2021. Hopefully this doesn't cover up. So here we have a 2020 and 2021 with the new algorithms and with the old one. And so even though the 2020 was more profitable for the older algorithms, if we put it all together anyway, I mean, not considering the added slippage, theoretical added slippage, we would end up with the newer algorithms plus 277% compared to 233%, and a maximum drawdown of 20% with the new algorithms instead of a maximum drawdown of actually double. And again, the average drawdown is also quite higher for the older algorithms and much smaller for the newer one. And Sharpe ratio goes from the new one 3.4, the old one 2.2. And the number of trades, it's of course is going to be the sum of 2020 and 2021. It will be 354 for the new algorithms and 1,307 for the older algorithms. And now let's do again the simulate doubled commission. And we double the commission, the cumulative 2 years on Bitcoin only, it becomes pretty poor, 35%, 56% maximum drawdown. With the new one, it's barely touched. I mean, we went from 277 to 206%, at 25% maximum drawdown. So yeah, basically, I think, I mean, again, this commission may be excessive. It's better to be safe. We should say also that in the case of Binance, the standard commission is really 0.04 on futures, although I think it may be increasing in the coming years. But yeah, it's definitely more scalable, the older algorithms, and overall it's a better performance. And again, this is Bitcoin only, as I mentioned. The newer algorithms, they were built to perform generally better with multiple markets and within the context of portfolio management, because in some cases, the older algorithms, they can be much worse in some markets, but we also rely on the portfolio management to automatically select the markets and completely unplug certain markets from the strategy, the algorithms at any given time. So the actual final system to make a concrete profit is built on many blocks, and here we are only looking at some parts of it, important parts of it, but not the whole picture. And that's why it's difficult to make sense of a strategy, because it has to be quite complete and have a bunch of pieces, and they all need to be tested together, which is something that we do, but we are not doing in this case here for the sake of of this short presentation. So yeah, think I didn't leave anything out that I wanted to mention. I just think that the newer algorithms, the only drawback really is that because it's much less trades, when things go really well, the cumulative effect it's less because more the string of winning trades, more trades, especially when using leverage, can bring quite a bit more profit when things go well. But of course, if things don't go well consistently, it's kind of pointless. Another thing at the personal level, we do as our users, we actually ask our users to make an account, Binance or Bybit account with our referral. And so with this kind of trades, we actually earn quite a bit more from the volume that is generated from the users. With this, we make quite a bit less. But again, our commitment is really first and foremost to generate profit at a limited amount of risk. We do this for ourselves first and foremost. So what works for us will work for others. If I mean, yeah, that's a separate argument, but really there is so much push by either tools developers or exchange themselves to generate more and more volume from the users. I think that's usually for the worst. Many times less trades is better. And I think in some cases this proves it. But really, let's see, we're only in the first month into 2022. Really, we'll have to see how it's going to go. I'm pretty positive. I'm pretty happy with how things are going, all things considering. But you know, development never stops, so we'll see how it goes. I hope this was useful. As usual, we're always open to discussion, whether there are more or less technical reaches on server on the Discord server if you want to chat with us. And until then, see you, have fun, bye.